Did you know that up to 90% of professional fund managers fail to beat the market over time? Yet these experts still collect millions in fees from unsuspecting investors. What if I told you that building wealth through investing isn't about finding the next hot stock or paying for expensive advice? It's about understanding a few simple principles that the financial industry doesn't want you to know. Today, I am going to reveal the exact system that I use to analyze any fund before investing a single pound. This is the same approach that helped me build a £100,000 portfolio after moving to the UK from India with zero knowledge. But here is the thing, I am not going to give you a list of random funds to buy. Instead, I am going to show you the 4 critical factors that determine whether a fund will make or break your wealth building journey. By the end of this video, you will know exactly how to spot the difference between funds that will quietly drain your wealth and those that will help it grow. I am Dr. Suman and I am going to share practical financial strategies that actually work. What makes this video different is complete transparency, real numbers, real strategies, and solutions that anyone in the UK can implement. Whether you are just starting out or looking to optimize your existing investments, in the next 15 minutes, you will discover why passive investing consistently beats active management, the crucial differences between ETF, index fund, and mutual funds, the 4-part DCAA framework to analyze any fund in minutes. This isn't theoretical advice. I will analyze a real fund with these learning points so you can see this analysis in action. A quick disclaimer here, I am not a financial expert and this video is not financial advice. So if you need personalized financial advice, please go and check out the link for Unbiased in the description box below. There you can find financial advisors who can advise you based on your personal circumstances. Also, none of the funds that I'm going to share in this video are recommendations. So please do your own research before investing your own money. Investing carries risk and there is a possibility that you might lose your money. Let me tell you a quick story. When I first moved to the UK almost 9 years ago, I was completely overwhelmed by the investment options. Coming from India, everything was different. There was no PPF, no LIC policies, nothing was familiar in this country. I remember staring at my laptop screen, paralyzed by all the choices that was available to me. Should I pick individual stocks? Which funds are the best? Was I making a terrible mistake by choosing a fund? Then I discovered something that changed everything. Think of investing like a gardening. Active investing is like being the obsessive gardener who is constantly pruning, replanting, and fussing over every plant. Passive investing, on the other hand, is like you are planting perennials that grow steadily with minimal intervention. The data is overwhelmingly clear. According to S&P indices versus active scorecard, about 88% of active fund managers failed to beat their benchmark over a period of 15 years. That's not just a small margin, it's a financial wake-up call. But here is what really blew my mind. The simplest approach was actually the most effective approach for long-term investing. By focusing on low-cost index funds and ETFs that simply track the market instead of trying to beat it, you could outperform most professional investors. The beauty of passive investing lies in 3 main advantages. Number 1 is lower cost. Passive funds typically charge you less than 0.3% annually compared to 0.5 to 1.5% for most active funds. This might seem small, but over decades, this difference can literally cost you hundreds and thousands of pounds. The second reason is tax efficiency. Because passive funds trade less frequently, they generate fewer taxable events and keep the cost down. This is not a problem if you're investing within an ISA, but a problem if you're investing outside it. And the third reason is simplicity. You don't need to constantly monitor the market and worry about picking the winning stocks. This frees up your time and mental energy for other things in life. For example, earning more money. Now, does this mean active investing never works? Of course not. Some managers do beat the market, but identifying them in advance is incredibly difficult. It's like trying to find a needle in a haystack. Now that we understand why passive investing makes sense, let's explore the three main vehicles you can use for passive investing. The first one is ETF and mutual fund. These are index funds, ETFs, and mutual funds. I will explain each one and help you understand why you might choose one over the other. Let's start with index funds. Imagine you are at a buffet in a restaurant. The index fund is like taking a small portion of every dish available, giving you the taste of everything. An index fund holds all the securities in a specific market index, such as the FTSE 100 for the UK or S&P 500 for the US. Their sole purpose is to track the performance of that index as closely as possible. For example, if you invest in a FTSE 100 index fund, you essentially own tiny pieces of the 100 largest companies listed on the London Stock Exchange. When the FTSE 100 goes up 1%, your investment should also go up by 1%. The beauty of index funds is the simplicity and low cost. Since they are not trying to beat the market, just match it, they don't need expensive research team or frequent trading. All of this could be done by a computer algorithm without involvement of a human to decide which companies to buy. Now, ETFs are similar to index funds in that they often track an index, but they trade differently. Think of ETFs as the more flexible cousin of index funds. While traditional index funds are priced once per day after the market closes, the ETFs trade throughout the day like individual stocks. This means you can buy or sell them whenever the market is open, like any other stock, and you will know exactly what price you are getting. ETFs also tend to be more tax efficient than traditional index funds because their unique creation or redemption process. Again, this is particularly important if you are investing outside the ISA accounts. Another advantage is that ETFs often have lower minimum investment requirement. You can buy as little as one share, making them accessible even if you are starting out with a small amount. Funds, on the other hand, can be either active or passively managed. The passive ones are essentially index funds, while active mutual funds employ managers who try to outperform the market. Mutual funds were the original way most people invested before, and they are still one of the most popular options by a lot of retail investors. Funds are priced once daily, similar to index funds, and they usually have higher expense ratios if it is an actively managed fund. Now, one advantage of mutual funds is that they sometimes offer access to market or strategies that might not be available through a simple ETF or index fund. However, for most core investments, the higher cost of fund don't justify the potential returns. Now, which one should you choose? Let me break down when you might choose each of these options. Choose an index fund when you are investing regular amount like monthly contributions, or you want simplicity in your portfolio, or you are investing in tax sheltered accounts like ISA or SIP. Choose an ETF when you want intraday trading, though I am a long-term investor and I would never recommend intraday trading. You can also choose an ETF when you are particularly worried about the tax efficiency outside your ISA or SIP accounts, or you are investing a lump sum, then ETF could be an option. Another reason for choosing ETF will be when you want access to a very niche or some thematic markets, then ETF could be an option for you. Now, when should you choose a mutual fund? It's an option when you are investing in less efficient markets. You need active management to generate good returns for you. For example, emerging markets. You have access to a fund with proven long-term track record of outperformance over time, and you are willing to pay the higher fees for the possibility, not a guarantee, of better returns. Remember, investing is not about getting rich quick. It is about getting wealthy slowly but surely. For most of us, a portfolio with primarily low-cost index funds or ETF will be the most reliable path to build financial independence. Now, how to analyze a fund? Here, we are going to talk about the DCAA framework. Now, moving on to the practical part, let's see how we can analyze a fund before investing. This is where most investors gets overwhelmed. But I am going to show you exactly what metrics matter and how to interpret them. I use something I call DCAA framework to evaluate any fund that I am considering for my own portfolio. Let me break it down for you. The first one is D for diversification. That means what you own. The first thing that you should analyze is what the fund actually invest in. This is arguably the most important decision that you will make, as studies show the asset allocation determines the vast majority of your long-term returns. When analyzing the fund's diversification, always consider how is the underlying index constructed. Is it weighted by market capitalization, which is the commonest method, or it is a equal weighted where each of the share will have equal weight, or factor based, for example, value or momentum based fund. Each of this approach has different risk and return characteristics. Next thing to consider is the geographic exposure of the fund. Is the fund focused on the UK or developed market or emerging markets, or is it just a global fund? Your geographic allocation should align with your own investment goals and risk tolerance. Next thing is sector breakdown. Check if the fund is heavily concentrated in particular sectors. For example, a FTSE 100 index fund will have significant exposure to financial and energy companies, while a Nasdaq 100 index will be tech heavy. Next thing to consider is the diversification in the fund. How many securities does the fund hold? Generally, more is better for a core portfolio holding, as it reduces company specific risk. Here is something that most people miss. Even funds that seem similar can have dramatically different compositions. For example, two global equity funds might have vastly different allocations to the US, emerging markets, or specific sectors. For most investors, building a core portfolio, broadly diversified funds covering major market segments make the most sense. More specialized fund can be added as satellite position once you have your core covered. Next is C for cost. That is the money that you pay to the fund. This is absolutely crucial for long-term performance. As Warren Buffett says, costs are a drag on your returns. If the returns are going to be 7% and the costs are going to be 1%, this is going to eat up 1/8 of your total fund return. When analyzing a fund's cost structure, look at the expense ratio. This is the annual fee expressed as a percentage of assets. For core index funds tracking major markets around the world, aim for expense ratio under 0.2% for traditional index funds and under 1% for ETFs. The next thing to consider is the tracking difference. This goes beyond the stated expense ratio to show the actual performance gap between the fund and its benchmark. Ideally, this should be close to the expense ratio. The next thing to consider is the trading cost. For ETFs, consider the bid-ask spread, that is the difference between buying and the selling price. Funds with higher trading volume typically have tighter spreads, reducing your cost to get in and out. The next thing is tax efficiency. Some funds are more tax efficient than others due to their structure and management approach. This is particularly important for investments outside your ISA and SIP accounts, because within this accounts you don't need to worry about tax savings. Here is the practical guideline for expense ratios based on fund type. Most major market index funds like the S&P 500, FTSE 100 will charge you under 0.1%. Developed market international funds will charge you under 0.2%. Emerging market fund will charge a bit higher, 0.3%. Specialized funds or thematic funds could charge you going up to 0.4 to 0.5%. Remember, a seemingly small difference in fees compounds dramatically over time. Also, when your portfolio is small, like 10-20,000 pounds, don't worry too much about the fees. But when it crosses 50,000, then you need to rebalance your portfolio, keeping the fees in mind. A 0.5% higher annual fee on a fund can reduce your final portfolio value by over 10% over 30 years. That's potentially tens or even hundreds of thousands of pounds. Next thing to consider is how you buy your fund. The third factor is how easily you can access and manage your fund. Some funds require a minimum initial investment, which could be a barrier if you are starting out small. Trading flexibility could also be important because ETFs offer trading flexibility, whereas mutual fund or index funds can only be bought or sold once in a day. Availability of the fund is also an important factor. Is the fund that you are planning to buy available on the platform where you are investing? Some platforms like InvestEngine offers commission-free trading for certain index fund or ETFs. Also, does the fund automatically reinvest your dividend, which is called accumulating version, or pay out the dividends to you, which is called distributing version? This affects both the tax efficiency and the effort required to manage your investments. Simply for long-term growth of your wealth, go for the accumulating version. And if you want regular dividends, then distributing version of the fund could be an option for you. Another important consideration is the currency for the fund. For some international funds, check if they are hedged or unhedged against currency fluctuations. For most UK investors, accessibility is rarely a major issue with mainstream fund, but it's worth checking these details before investing, especially if you are using a specific platform or have particular requirements. The next A that you should consider is assets under management or AUM of the fund. This is a critical factor to determine the fund's size, and this is measured by AUM. This might seem less important than the other factors, but it can significantly impact a fund's viability and efficiency. When evaluating a fund's AUM, always consider the economies of scale. That means larger fund can spread fixed cost across more assets, potentially leading to lower expense ratio over time. Again, a fund with higher AUM typically have better liquidity. That means you can buy or sell shares more easily without affecting the price of the fund. Another thing to be aware is a closer risk. For very small fund, which are less than 50 million pounds, they face higher closer risk if they are unable to attract sufficient investor interest. Fund closures can create unwanted tax events and disruptions. Next thing is tracking capability. For certain markets, especially less liquid ones like small cap stocks or emerging markets, excessive fund size can actually hinder the performance as the fund becomes too large to efficiently track its index. A general guideline here is for major market funds, prefer our AUM over 1 billion. For specialized or niche funds, at least 100 million plus being preferable. For broad market ETFs, higher AUM typically correlates with better liquidity and tighter spread. When I analyze funds, I am cautious about brand new fund with low AUM unless they are from a very established provider like Vanguard or iShares. This is also a very important consideration for a fund about who is the provider for the fund. When you have big fund houses, for example Vanguard, iShares by BlackRock, then you know that this fund is being backed by large fund houses and chances of this going bankrupt is quite small. Now moving on to the practical part. Let me show you how I analyze a fund using this DCAA framework. Here is an example of the Vanguard FTSE All World ETF or VWRP, which is a very popular ETF amongst UK investors. Let's start with the D or diversification. This fund tracks FTSE All World Index, providing exposure to large and mid-cap stocks across developed and emerging markets around the world. If you look at the regional breakdown, then it invests in North America 60.1%, Europe ex UK 10.9%, Japan 5.4%, Asia ex Japan 5.2%, emerging market 4.6%, UK 3.7%, and rest of the world 5.5%. The fund holds thousands of stocks across 47 countries around the world, giving you truly global diversification in a single fund. Looking at the top holdings, you can see the fund includes global giants like Apple, Microsoft, Nvidia, Amazon, Meta, Alphabet, etc. While these top companies represent significant positions, the fund remains well diversified with thousands of holdings across various sectors and regions around the world. The next is C for cost. The total expense ratio for this fund is 0.22%, which is competitive for a global fund with emerging market exposure. The fund uses physical optimized replication, which means it actually holds the underlying stocks rather than using derivatives. It's an accumulating fund, so the dividends are automatically reinvested without you having to do anything about this. This makes it tax efficient and ideal for long-term growth. The fund is not ESG screened, which is important to know if environmental, social, and government factors are important for your investment strategy. A for accessibility, VWRP is widely available on most UK investment platforms. As an ETF, you can trade it throughout the day and there is no minimum investment beyond the price of a single share. Currently, it's around £100. Being an accumulating fund means dividends are automatically reinvested, simplifying management. The next A is assets under management, or AUM, of the fund. With over 20.9 billion in assets, this fund has substantial scale, ensuring good liquidity and minimal risk of closure. The large AUM allows Vanguard to keep costs low through economies of scale and ensures efficient trading of the underlying securities. Based on this analysis, VWRP meets all the criteria for a high quality fund: excellent diversification, reasonable cost, good accessibility, and substantial AUM. It would make an excellent core holding for many UK investors seeking global equity exposure through a single fund. However, this is not a recommendation. Please do your own research before actually putting your money in this fund. Before we wrap up, let me share some common mistakes I have seen investors make when it comes to fund selection and passive investing. These are things I wish someone had told me when I first started. First, don't chase past performance. Just because a fund performed brilliantly last year doesn't mean it will continue to do so. In fact, studies consistently show that last year's winners often become next year's underperformers. Focus on the factors we have discussed: diversification, cost, accessibility, and AUM, rather than recent returns. Second, don't ignore the impact of taxes. Even the best investment strategy can be undermined by poor tax planning, and this is why you should always choose the ISA account or SIP account to help you save taxes. Once you have completed your ISA allowance, then you can go for general investment account. Third is, avoid the temptation to frequently switch between fund or strategies. The market will always have ups and downs, and there will always be something that's performing better at any given moment. Patience and consistency are your greatest allies in building wealth. Remember, investing is a marathon, not a sprint. Fourth is, don't overlook the importance of your overall asset allocation. Even the best selected fund won't save you from having inappropriate mix of assets for your goals and risk tolerance. Before worrying about specific fund, ensure your balance between the equities, bond, and other assets is appropriate for your situation. Finally, don't fall prey to investment FOMO, or fear of missing out. There will always be a trendy new sector, theme, or strategies promising extraordinary returns. Most of this end up disappointing in the long run. Stick to your plan and avoid being swayed by market hype or what others are doing. I learned this lesson the hard way when I first started investing. I kept jumping from one hot investment to another, chasing whatever was performing well at the moment. The result, I missed out on the steady compounding that comes from staying the course. Once I committed to a simple diversified portfolio of low-cost index funds, my wealth started growing consistently. Now let's talk about something that separates the good passive fund from great ones, and this is called tracking error. This might sound technical, but it's actually quite simple. Tracking error measures how consistently the fund follows its benchmark. Think of it like dog walking on a leash. How closely does it follow its owner? A well-behaved dog or low tracking error stays right by your side, while an untrained one or high tracking error wanders all over the place. In simpler terms, the tracking error tells you how much the fund's performance wobbles around the benchmark's performance. The lower tracking error, the better the fund is doing its job of passively tracking the index. Here is how to set appropriate tracking error thresholds based on your type of fund. For major markets, equity fund, S&P 500 or FTSE 100, it should be under 0.2%. 0.2 to 0.5% is good. Anything above 0.5% raises questions. For international developed market fund, under 0.3% is excellent. 0.3 to 0.7% is good, and above 0.7% raises questions about the fund. For emerging market, under 0.5% is excellent. Anything above 1% raises questions. For a bond fund, under 0.2% is great. 0.4% or above raises questions. For specialized or thematic funds, under 0.7% is great. 0.7 to 1.2% is good. Above 1.2% raises questions about the fund's performance. Now, what causes high tracking error? There are several factors. For example, sampling, that is not holding all the securities in the index. Another one is cash drag, that is uninvested cash in the portfolio. Third one is optimization techniques like trading cost and timing differences. The fourth one is securities lending activities. Here is something that most people miss. A fund with slightly higher expense ratio but lower tracking error might actually deliver better net results than a cheaper fund with poor tracking. This is why you need to look beyond just the headline expense ratio. For most long-term investors, consistency is the key. A fund that reliably tracks its index with minimal surprises will help you stick to your investment plan through market cycles. So there you have it, the essential guide to analyzing fund and mastering passive investing. Let's quickly recap what we have covered in this video. We have seen why passive investing consistently outperforms active investing for most investors. We have clarified the differences between ETF, index fund and mutual funds so you can choose the right vehicle for your investments. And most importantly, we have walked through the DCAA framework that takes the guesswork out of fund selection, diversification, cost, asset allocation and AUM. But are you really ready to start investing? I have created a quick assessment quiz to help you find out. Please check out the link in the description box below. For those who are ready to get started, I have partnered with Invest Engine to offer you a special bonus. Use my link in the description to sign up to Invest Engine, where you can start your passive investing journey. For getting the bonus, you have to invest at least £100 and stay invested for next 12 months. Terms and conditions apply. I may receive a small commission if you use my link to sign up to Invest Engine account. If you found this video helpful, please hit the like button and share this video with your friend who is planning to start their investing journey. Subscribe to this channel for more investment videos and financial content. This is Dr. Suman, helping you build your wealth one step at a time. See you in the next video.